Hello, this is Julius from Basic Financials. Today I'm going to talk a little bit about relief for interest on loans and other financial charges when you've got that loan, so that you have been able to buy a rental property for basically renting out. So you've got your rental income, your various other expenses, and then probably one of your biggest expenses, if you've taken out a loan to buy this property, will be that mortgage interest. Things changed a couple of years ago with regard to mortgage interest relief for rental properties. It's part of the government's plan to make things a little bit less attractive for buy-to-let landlords. The other thing that they did was introduce a 3% surcharge on stamp duty for people buying a second home or second property. So that directly, if you've got your own home and you're living somewhere and you decide, I think I've got a bit more money here, I'm going to buy a property to rent out. When you buy that property, you'll have whatever the stamp duty would normally be, even if it was 0%, there would automatically be a plus 3% on your stamp duty charge. So that was another reason, that was another thing they did to try and make it a little less attractive for landlords. But this mortgage interest relief, what often used to happen would be that people would take out an interest-only loan. They might put a 10% or 20% deposit down on the property and buy the rest of it with a loan, interest only. And then the bank would have a charge over the property, so they would be fairly happy, because if you didn't pay your loan, they would just repossess the property, so they would get their money. You might have to have some life insurance as well, but the main thing was that it would be an interest-only loan, so that your repayments of that loan wouldn't need to be more than is necessary. So imagine if you've got your rental income and you've got to pay capital and interest, you might not be getting enough rental income after your expenses to be able to pay that capital and interest. So it made it more tax efficient and more cash flow efficient to actually have an interest-only loan, and then the idea is that when you sell that property, you then repay the loan. Now the other thing with that was you used to be able to get full tax relief on that interest. So if you were a higher rate taxpayer, what would happen is, well, if you were any type of taxpayer, you would have your rental income, you'd take off your expenses like repairs, your gas safety check, all that sort of thing, and then you would take off your mortgage interest, and that would leave you with a net profit. And then that net profit would be taxed at whatever your marginal rate of income tax was. So if you're a 40% taxpayer, then you would be paying 40% tax on your profits, having taken off that interest. Now what's changed is that the government had decided, well, we're only going to allow basic rate relief on the interest. So if you're a basic rate taxpayer anyway, it will have no difference to you at all in the tax effect. It might look a little bit different on your tax computation, but the actual amount you end up paying would be no different. If you're a higher rate taxpayer, then you're worse off by tax because you're only getting half of or part of the interest at 40%. Now the way they're doing it, they're phasing it in. So for the year ended 5th of April 2018, 1/4 of the interest would be allowed against, 3/4 would be allowed against your income as an expense, and then the other quarter, you would take tax or 20% of it and has that as a deduction from your tax bill. So that's how they make sure that you only get the 20%. For the year ended 5th of April 19, it's half of the interest is allowed against your rental income as an expense, and then half will get a 20% tax deduction. Next year, so for the year ended 5th of April 2020, it's going to be 1/4 allowed against your income, and then 3/4 will get the 20% tax deduction. And then the year after that, so the year ended 5th of April 2021, all of it will be allowed as a tax deduction. So what will happen is when it's all phased in properly, all that interest you won't go against your income. You'll have your rental income, you'll have your expenses like your repairs and your gas safety check, and that will be your net profit, and you'll pay tax on that. And then they'll look at the interest, take 20% of that, and you'll get that as a tax deduction from your overall tax bill. So that's how it's changed. So if you're a basic rate taxpayer, then it won't make any difference. There is one thing, if you can only get a basic rate tax deduction to the extent that you actually have paid basic rate tax on your rental income. So if for some reason you don't have any other income and your profits were under your personal allowance, you wouldn't be able to get a tax deduction for your profits. So what would happen is that tax deduction is carried forward to later years. So if you don't get to use your 20% tax deduction for some reason, then that will carry forward to later years. You might have had a loss, you might have had a big repair bill or something in the year, so you didn't make a profit. You might have made a loss, so you wouldn't get you would effectively have lost your tax deduction, but you will get it because they'll carry it forward. Very complicated now, isn't it? But that's the way it is, and the idea, as I say, was to try and make it a little less attractive for landlords, so you can't just go out and get big loans, buy properties, inflating house prices. Probably a good idea in the long run, but and then might enable other people to buy houses to live in rather than rent out. That's another story. So I hope that helps a bit with understanding that, and I will see you again soon. If you like and subscribe, got any comments or questions, leave them in the place below, and I'll see you again soon. Thanks for listening.